Williams, Chief Executive of Charteris, joins us now. Hi, Ian. Hi. It's interesting, you were showing me just before the break, the spreads
spread betting,
on the election victory, they differ from the polls.
Oh, markedly different, I mean, the Conservatives in seats that you can deal on, and these are live prices, is 334 bid, 339 offered, and the Labour seats are 216 to 219 offered. So that's a big difference to what a lot of the opinion polls and commentators are saying.
From where you're sitting, would such an eventuality, would such an outcome be positive for the stock market, positive for the UK economy?
I think yes, on balance, I think the markets would prefer a Conservative majority, and I think they would prefer someone who's going to really get to grips with the budget deficit. I think the budget deficit is the one overriding factor that the markets are looking at, and I think they would have more confidence that the Conservative administration would get to grips with it rather than the Labour. I mean, they're all saying, all three parties are saying they're going to get to grips with it, but some are more believable than others.
Confidence in the Tories getting to grips with it. I mean, your premium growth fund is a FTSE 100 equity fund. How should we position ourselves, Ian, in this time before the election? What would you recommend?
Okay, well, that's doing quite well at the moment. It's like at the top of its league table, and the reason is that for the last year it's been concentrated in overseas earners, and we haven't really got any stocks in that fund that are too concentrated on the UK economy. So we don't have Marks and Spencers in the fund, we don't have Next, we don't have British, we don't have any commercial property companies. So where the reason that fund has outperformed is because it's full of overseas earners. Sterling has gone down, so all the overseas earners have benefited to the more than the...
Do you still then have faith that sterling's fortunes will remain
well, I think sterling
downbeat?
Yeah, I mean, we could see sterling continue to weaken whoever wins the economy. I don't think that's going to be one of the issues that's going to be dependent on the election. I think you need to see more evidence that the fall in sterling has had an impact on the economy, and we haven't really seen it yet, although there are one or two tentative signs. I mean, these Land Rover figures, Jaguar Land Rover figures, stunning figures. Of course, a lot of that come from exports, so possibly we are starting to see some signs that the fall in sterling you've already seen is starting to feed through, but not very, they're only very tentative signs, and we would think you'd still need a bit more decline in the exchange rate.
What about the feed through into inflation, Ian? If sterling remains weak, you're importing inflation. We've got the Bank of England meeting today. Is that something they'll be keeping an eye on? Does that push forward the first interest rate hike date?
Possibly, but one of the reasons perversely we look at it the other way around, one of the reasons we think sterling is going to continue to be weak is we think interest rates are going to stay low for a long period of time. Whoever wins the election, we don't see interest rates going up anytime soon, because the forces at work within the domestic economy are more deflationary than inflationary at the moment, and we see that continuing for a while, and whoever gets in, if they're going to cut the deficit, that's going to add more of a recessionary, deflationary force on the economy, which is going to imply, the more they get to grips with the deficit, it more implies monetary policy will remain weak and easy for some time to come, as a balance to the tightening of the fiscal policy.
30 seconds on gilts. I mean, your gilt fund has done remarkably well, hasn't it?
Yeah. Well, again, we see it's concentrated in the sweet spot of the yield curve, which is about 8-year gilts, and we don't hold any 50-year gilts, because we think they offer more risk than reward. Again, we see interest rates remaining low for a long period of time. So
go for the 8-year portion. That's
the sweet spot of the curve.
Ian, thanks for joining us today. Ian there from Charteris. Right.